Hello, today I'm going to talk about term insurance. In order to understand term insurance, it's going to be important to frame it in terms of what it's contrasted against. So there are two different kinds of insurance. We're talking life insurance products, two different kinds of life insurance products. And basically the difference is this: one is going to be temporary, one is going to be permanent. Now, in between those two, there are a couple of other options, but in this video, I'm just going to be focusing on the temporary component. So, just briefly, temporary insurance is term insurance. Permanent insurance, the sort of brass standard, the gold ring for permanent insurance, is going to be what's called whole life. Now, term is sometimes referred to as pure insurance or pure protection. And what's referred to there is the idea that term insurance does not have a savings component. It does not have a cash value associated with it. So temporary insurance, term, no cash value; permanent insurance, basically whole life, savings component, cash value. What is cash value? Well, let me come at that question in virtue of an analogy. Think about the difference between renting a home or an apartment and buying a house. When you rent, you're not building up any equity in that property. You are paying a landlord, and what you are getting in return for your payment is a roof over your head. Or to put it a different way, you are purely paying for some place to live. You've got pure roof over your head protection in that case. You are purely paying for a roof over your head. On the other hand, when you buy a property, or at least when you pay toward a mortgage in order to become the owner of a property over time, you are building up equity in that property. Now, the difference between term insurance and whole life insurance isn't precisely the same, but it's pretty close in this respect. When you are paying in premiums into a term policy, you are not building up any cash value. When you pay premiums into a whole life policy, you are building up cash value. And cash value is something like the equity that you would have in a property. Now, it's a little different in the sense that the equity in a property is going to be the money that you would basically get in the event that you liquidated the asset and after you discharged whatever debt that you had on that asset. So if you buy a house, a $250,000 house, and let's say you put 20% down toward that property, so you're putting $50,000 down and you're going to finance $200,000, then you have built an immediate $50,000 worth of equity in that house. It is not so much that you are spending $50,000 as you are simply transferring $50,000 from some cash position or some cash vehicle, savings account maybe, or checking account, and you are moving that into your real estate. So now your real estate has got $50,000 worth of equity built into it. And what that would mean would be, let's say, and you wouldn't ordinarily buy a house if you intended to do what I'm about to describe, but if you did, it would work out something similar to this, abstracting away from things like closing costs and other fees that would be associated with actually completing the sale of the house. The basic idea would be, if you had a $250,000 house and you had put $50,000 down on the house, when you go to sell that house, assuming its value is at least the same as it was before, the market value of the house, then you would have $50,000 that you'd be able to extract from the house, and the remaining $200,000 that you get from the sale of that house would go to discharge your loan. So in other words, you buy a $250,000 house, $50,000 down, you finance $200,000, you sell the house. Now the $250,000 from the sale of the house goes to discharge the loan, pays off the bank, $200,000, and you get your $50,000 back. Now, in the case of whole life insurance, the cash value that you pay into the policy can work very similar to this, and I will go into that in another video. So you can pay into a whole life policy. There's something, in fact, called a single premium. You put, let's say, $5,000 down on a policy, and maybe at the age of 65, that $5,000 buys you $10,000 worth of coverage. You have no other premiums due on that policy. And now when you go to, if you went to cash that policy out, you would get your $5,000 back plus interest. The same way as if you went to go sell a property after you put money down, you have equity built in the property, assuming the value of the properties hold steady or increase, you would get your cash back. But term is different. So term is like renting, where there isn't any sort of equity that you build up in the property. Now, this isn't bad. There are many conditions under which a person would be advised to rent, and there are many conditions and circumstances in which a person might be advised to purchase term insurance. Now, there are different kinds of term insurance. Now, there's a number of different ways to think about this, but I'll sort of think about it in terms of a couple of things here. First of all, there's going to be a difference in term insurance in terms of whether or not the death benefit remains level, whether or not it goes up, or whether or not it goes down. So if the death benefit remains level, we call it level term. If the death benefit increases, we call that increasing term. And if the death benefit decreases over time, we call that decreasing term. Now, the term is the length of time that the policy is in effect. So, as I began the video by saying, term is temporary insurance, meaning that term will cover you for a short space of time, but not for the whole of your life, unless you die during the term. Now, some statistics suggest that fewer than 2% of term policies actually pay out. And this is in part because the people outlive their term. So maybe you get a 10-year term, or 15, 20, 30-year term. So your term policy is going to cover you for 10 years. It'll cover you for 15 years, for 30 years, whatever the length of the term is. Now, let's say you are 30 years old when you take out a 30-year term policy, right? Well, if you outlive your term, then that policy will not pay out unless you renew it, and we'll get to that in a moment. We wouldn't say that's a bad thing, because it implies that you are now age 60 and older. You haven't died by age 60. That's a good thing. Life expectancy for the average male is in the mid-80s. Life expectancy for the average female is close to 90. So it's not a bad thing that you didn't die early, but at the same time, your term policy will lapse if you don't renew it, if you bought it at 30 and you had a 30-year term. Now, what would a person want these various policies for? So, for example, some things that term is used for, decreasing term might be used to correspond with a mortgage payment. So maybe you owe $200,000 on your mortgage, and as you pay it off, let's say you have a 30-year loan and you're paying close to $1,000 a month, so you're paying it down at the rate of about $12,000 a year, let's just pretend. And so over time, your mortgage amount that you owe is going to decrease. So some people prefer a term product that is designed to sort of keep pace with their mortgage payments, more or less, and over time that term amount decreases as you pay your mortgage down. Level term might be used for income replacement. So, for example, a person who is, let's say, 30 years old, makes $100,000 a year. Over the next 30 or 40 years, that person would be expected to bring in about $3 or $4 million in just income, abstracting away from cost of living increases, abstracting away from raises. It's simply $100,000 times the number of years we expect them to work. Let's say they intend to retire around age 70, right? Make the math easy. So 100,000 times 30 years is 3 million. 100,000 times 40 years would be $4 million. So it may be that a level term policy is used to cover some of that. Now I'm going to put a big asterisk on that because there are a number of different calculations that can be used to try to ascertain need, and the only reason I am doing it in this clumsy way presently is simply to give you a fix on the numbers. I'll have a separate video that will be dedicated to the different methods, and there are different schools, but the different methods of calculating what a person's insurance needs would be. Now, increasing term might also be used for income replacement, but with increasing term, perhaps we know that this 30-year-old is on track in his or her job to receive increases in pay over the next 5 or 10 years. So it may be that an increasing term policy is able to keep pace with these raises without the person having to re-underwrite for a certain amount of coverage more. So if we wrote a $3 million, $2 million, $3 million policy on a young person, It may be that it provides for certain increases in coverage level as their salary increases. Now, again, there are complications. If term is used for income replacement, then on the face of it, the amount of term that's necessary will go down as the years advance because the person is going to have fewer working years remaining. Now, there's another special kind of term that is called annual renewable term. Now, annual renewable term is termed just like what it sounds. Every single year, the insured has the ability to sort of re-up that policy, but in annual renewable term, every year the policy gets a little bit more expensive. With, say, level term, the expenses are averaged over the life of the term. So let's say compared to an annual renewable term, a level term may be more expensive year one, and an annual renewable term is probably going to be more expensive, let's say year 10. If you keep, let's say, have a 10-year term compared to an annual renewable term, the annual renewable term will start out less expensive but get more expensive as the time period proceeds, whereas the level term will start out more expensive but will end up less expensive than the annual renewable term because its cost has been averaged over the length of the term. Some other kinds of term, there is return of premium term, which return of premium generally is handled with some sort of a rider that provides that if the insured dies before the term completes, then there will be a refund of some or all of the premiums that were paid into the policy. Now, this kind of a rider is going to be expensive to add on, but the benefit of it is if you know fewer than 2% of term policies pay out and you have the money available to pay for the extra rider, then in fact getting some of your money back or all of your money back that you paid in premiums can be an attractive proposition. There's also renewable term. So for example, let's consider a person who is 20 years old who buys a 20-year term policy. Well, that term policy is going to expire by the age of 40. So if their policy is renewable, that means that at the age of 40, that individual will receive an offer to extend the term, let's say for another 20 years. And that will be done. If it is renewable term, then that renewability is guaranteed on the basis of the underwriting that was performed at age 20, which means that that individual at age 40 is guaranteed to be able to continue that policy. However, it's not going to be continued at the premium rate that was assessed when they were age 20. The premium rate will be reassessed to their new insurance age, 40, but they don't have to go back through underwriting in order to renew that term. They have to pay more, but they won't have to go back through underwriting. Now, that's attractive if the individual is as healthy or less healthy than he or she was at age 20. In some cases, maybe a person has gotten into a health kick in their 30s. Maybe it would be an opportune time to re-rate them or to apply for a different policy to try to get them a better preferred rate. But in the case of many people, as they age, their health is going to sort of decline, and it's somewhat comforting sometimes to have a policy with the renewability privileges baked into them so that there doesn't have to be another health assessment, a paramedical or anything like that when the renewability comes up. Finally, there's something called convertibility. And in this case, we're talking again about the difference between temporary insurance, term, and permanent insurance, for example, whole life. Well, if the term insurance policy is convertible, then that means that that term insurance can actually be transformed into some sort of permanent whole life policy, generally. And in that case, the reason again is because, number one, fewer than 2% of term policies, it's said, statistics, you can sort of Google this, fewer than 2% of term policies pay out. So it's nice to have the ability to transform that term policy into one that will be in place. It's sometimes said the only life insurance policy that matters is the one that's in force on the day that you die. So if you know there's a low likelihood the term policy will pay out and you want to have some protection in force at the time of your death, then it is a nice option to have to be able to convert that term policy into a permanent policy somewhere down the road. Various other riders can be available on term policies. Sometimes there are disability waivers that provide for the premiums to be paid or waived in the event that the insured is disabled and unable to work. Other riders can attend, sometimes family riders, additional coverage for children or spouses. Each rider is available depending on the insurance company, and various costs can be assessed for these, but they're nice. They're sort of like features when you buy a car that enable you to customize the car and to have features that are meaningful to you. Again, some uses for term policies include income replacement, mortgage protection, as was mentioned previously. Another is student loan payoff ability. So God forbid, let's say a young person takes out a student loan. If that, God forbid, young person were to die before that loan was paid off, if it's a non-forgivable loan, then perhaps the father or mother who co-signed is going to be on the hook for that bill. It's sometimes the case that it's nice to have some kind of a policy that is keeping pace with the student loan payoff, so that in the unforeseen and unfortunate circumstance of the child's death, that student loan can be discharged. Similar things can be said for vehicle loans and other sorts of personal loan. And term policy can also sometimes be used for something called pension maximization, and that will be a complex topic that I'll get into in another video. Now, term policies, again, are designed to cover for a period of time. After that period of time, the term policy concludes. A term policy might terminate prior to the conclusion of its contractual term in the event that, let's say, premiums are not paid. But generally speaking, if the premiums are paid, the term policy will go from whatever date the contract is issued until such time as the term concludes. So some pros with term insurance. So term gives you a lot of insurance bang for your buck. You get a high amount of death benefit for a comparatively low amount of premium. Another is that term policies have a lot of versatility. There's a number of things that can be done with them, from income replacement to discharging various loans, as we just surveyed. Finally, term policies have no cash value. Now, I'm going to list this as both a pro and a con, and that might seem somewhat odd and even contradictory, but what I'm trying to underscore in virtue of doing that is to say that there are competing philosophies for how to calculate death benefits, for how to use insurance in your financial portfolio, in your financial planning. And one perspective, popularized by such individuals as Susie Orman and Dave Ramsey, has it that you want to have term, so you have a particular whole life policy with a certain amount of premium, and you have a comparable term policy that has a lesser premium amount, then you want to elect to go with the term policy and then invest the difference that there would be between the whole life premium and the term premium. So you could consider the lack of cash value in a term policy to be a positive thing, a pro. And that would be on the assumption that you share the perspective and the advice of people like Susie Orman and Dave Ramsey. Some cons with term insurance. Once again, fewer than 2% of term policies are said often to pay out. Some of these are because the policies may lapse due to lack of premium payment, but in many cases it's simply because the person outlives the term. Other figures suggest it might be as low as 1% of term policies that pay out, but in any case, this is a negative when you think about funeral expense and some legacy planning, other things that are going to require that the policy be in force on the day that you die. But it's not necessarily a con if the purpose of the insurance is, let's say, to keep pace with a mortgage. And by the time the mortgage is paid off, you don't need the term anymore. It can be permitted to fall away. So whether this is really a con or not depends on what the purpose for the term policy is. So similarly, this highlights the fact that term policies have a limited period of being in force, and the protection will conclude after that time. But once again, whether that's a positive or a negative depends on what the term is being used to do. Once again, as I said, the cash value could be considered a positive, but it could also be considered a negative. So some people who would want to pay into an insurance policy would prefer to pay in such that they're building up some kind of cash value in that policy as they make their payments, rather than simply paying for pure insurance protection. Depends on the perspective that a person has about insurance. Another thing is the term policy may or may not be renewable, may or may not be convertible. And these can be cons if, for example, you are counting on having that term policy in place for a longer period of time, and you find out, oh, in fact, the term is up before you thought it was, or you thought that maybe you could extend the coverage by renewing it and that option isn't available, or if you come to desire permanent insurance and you discover that the term policy that you purchased isn't convertible, you may feel somewhat disappointed in those cases. Whether those are cons or not, again, depends on your purpose. So I say you would sit down with a person who is licensed to sell these products in your area, who you trust, and basically disclose to that person what your goals are and help him or her to shape a plan for you that makes sense using the right sort of insurance product. Ultimately, the differences between term and whole life are considerable, but again, some of that is going to depend on the actual purpose that you need or want to serve in virtue of having the insurance in place, and a knowledgeable advisor should be able to help you navigate through these waters. I cannot give you direct advice, but I can simply say the sketch of the difference between term and whole life, specifically a sketch of what term involves, is for information or entertainment purposes, and if you require more in-depth consultation, then you would want to consult with a professional in your area. Thank you very much.